Welcome, everyone. Good afternoon, and welcome to this panel on wealth management and fintech. It's either in wealth management or into wealth management. We have an awesome panel, as you can see here, a group of very familiar CEOs of high-profile and prominent companies. To my immediate left is Jon Stein, CEO of Betterment. To his left is Noah Kerner, CEO of Acorns. And to his left is Eric Poirier of Addepar. Welcome, and great to see you guys.
Thank you.
Great to be here.
So I think a lot of people are familiar with your companies, as I said, but I want to ask you just to give a brief description and also talk initially about, this fast growth platform and pattern that you guys have been on. I mean, all of you are growing so fast with different metrics. And I know, Jon, you have got, over $9 billion of assets under management?
Yeah.
So what's contributed most to that growth? And just remind us a little bit about what Betterment does, first of all.
Betterment is an online financial advisor, as many of you probably know. We have grown because I think it's obvious to a lot of people that the old way of managing your money just isn't working very hard for you, right? It's not in your best interest. It's not doing anything to actually maximize your money. And so as we're opening people's eyes to the fact that we can actually make them a lot more money by personalizing an account for them, we can make it more convenient, we can give them peace of mind about their full financial picture, it's just obvious that this is a better choice. And so it's grown faster than, say, mutual funds did when they first took off. We've grown faster than ETFs did when they were first introduced. And we've seen at the same time other industry incumbents coming in at a faster pace than they have for any change I can remember in financial services history. So it's an exciting time to be in this space.
Noah, tell us about Acorns. Gosh, you guys have got, over almost 2 million customers now? And so also fast growth. What do you guys do exactly? And what problem are you looking to solve for customers?
Yeah, thanks for doing this, by the way. So our customers are basically people who make under 100,000 household income, primarily. And what Acorns does is make it effortless to save and invest small amounts of money regularly. I think the thing that has probably contributed to the growth most is probably the spare change. People call it kind of our Trojan horse feature, but it's just basically this, this thing that happens in the background of life. So you connect a card to Acorns, and then everywhere you go and shop, we round up the purchase to the nearest dollar and invest a spare change. So it's sort of just happening, and it's really simple. We like to say we make big decisions small. So I think just stripping that away, stripping the difficulty and complexity as much as possible, and really focusing on that customer base that makes under 100,000 household income, which is pretty overlooked by the financial services industry generally.
Right.
So.
Eric, you're a little bit different from these two guys. I mean, in probably all kinds of ways that I don't even know about.
A little shorter.
Well, yeah. But you're a B2B company is what I was really talking about here, and these guys are B2C. Your numbers are huge. I think it's like, what, $700 billion on your platform,
right.
Managed through your clients, which are businesses.
Yep.
And if you think about it, like, it's got to be, I don't even know how many billions of dollars have been brought to bear into this business just in terms of technology investment. We'll get to that in a little bit. But why don't you sort of address the same question that Jon did? What's led to your growth trajectory?
Sure. So, when we started Addepar back in late 2009, it was in response to the financial crisis. And I think as many of us saw, some of the largest asset owners had the hardest time understanding even what they held, how they held it, and what they were exposed to. And so we really built Addepar to serve firms, as you pointed out, who offer financial services oftentimes to large end clients. And fundamentally what the product does is it gives advisors what they need to report in a tailored way to each and every end client about what they own, how they own it, what they're exposed to, so that therefore they can make a well-aligned decision on what to do about it. And so a lot of the growth is the fact that we're now giving technology to these advisors. To date, have been using Excel and a bunch of people to solve this problem in an operationally intense way.
So what kind of ways do you run your, I mean, a lot of people out here are running fintech companies. And so have you thought about how running your B2B business is different from running a B2C company?
Yeah, absolutely. So we end up being a close partner for a lot of consumer-oriented fintech companies. The way we look at it is, since we are dealing with some of the largest asset owners in the world, which actually to Andy, to your point before, there are $40 trillion worth of assets held globally by pensions, sovereigns, endowments, and foundations. Another 30 trillion held by high net worth or ultra high net worth individuals with at least $30 million or more. So if you look at that $70 trillion worth of assets managed by, again, Excel wizards, data janitors, basically people playing the role of middleware, when all of a sudden you have technology to play that role, we can empower consumer fintech companies, we can empower banks who've been doing this for a very long time, and it's all really pointing towards providing a tailored and differentiated service to each and every client.
Right. Noah, how big is the opportunity for your company?
So we've estimated there's about 182 million Americans that represent customer base for us. So we think it's that big. That's in the US. We're also in Australia. And I think globally, basically people who make under 100,000 household income, where we can enter those markets as opportunities there for us, and often just overlooked and underserved. And one of the things, this is a kind of small nuance, but this audience is often sort of referred to as underbanked, under this, under that, have-nots. It's sort of, we call them the up and coming, and it's a little bit of a twist on how to think about people in terms of, is not people, we don't look at it as like these people are sort of struggling, and we look at them as striving. And obviously young people, millennials tend to make less income just because they're younger, but as you get older, and you're still in that segment, and you're still every American is striving for that American dream, and so that's the customer base.
Do you feel like you don't feel like you need to serve people with more assets than that?
No, that's our customer base, and we're totally squarely focused on it. And I think it's important to be laser focused as a business.
Right. Jon, what is your competitive set? Do you compete against the legacy companies? Well, obviously, but do you compete more against the new fintech companies? How do you think about that?
Increasingly, we're thinking about our competitive set as those incumbents that have entered our space. I think for a while, I would have said it's obviously it's Vanguard, it's Fidelity, it's Schwab. That's where we get all of our assets from, and that's who we compete with. So our target customer has $100,000 to $2 million, say, and they're often investing on their own, or they're getting terrible advice from somebody, at a broker, an insurance salesperson, or somebody who's selling them product, because that's the way financial services works. It's a bunch of product salespeople. And we're a fiduciary. We act in our customers' best interest, and they come to us because they can get better advice. They've got enough money that it's important to them, it's meaningful to them. They get a significant, return on it. They worked hard for it. They want to put it to work best for them. And they know that these traditional firms aren't really operating in their best interest. So I think now of our competitive set, maybe more narrowly, is those firms who have recognize that this is the future of financial services. They are moving in this direction. But because they are mutual fund companies and their only incentive is to sell their own mutual funds, it's hard for them to really become a fiduciary and act in their customers' best interest. Or because they're a broker and they make their money just selling other people's products and getting commission for that, it's hard for them to actually think about what's best for the client. Our competitive advantage is that we are new. We have built in this customer-aligned way from the beginning, and that helps us to pick on the incumbents.
Now, you mentioned the word fiduciary, and we were talking back there that you're regulated, you're not regulated. True. That's crazy. Should he be regulated? No, I'm asking you.
So I think for us, regulation has been a really great thing, right?
Wow, really?
Yeah, absolutely. It creates in the first instance a set of rules that you have to abide by, and we've had exams every year since we were founded 7 years ago. I founded the company 7 years ago. Every year we've had multiple exams because we've been leading this new path. We've been blazing trails, and so the regulators rightfully are really interested to see what's going on. I talked to our competitors. They haven't been examined as much, right? But we're setting the standard, and I feel a real sense of obligation to raise the standards. We talk about the fiduciary standard. That's pretty good. We're up here. We're above that. We're doing more for our customers than most fiduciaries because it's what we believe. And I think the regulation should actually be elevated on everyone in our space. I think the DOL fiduciary rule is a great thing, for instance, and actually, I mean, no one argues that it's actually good for consumers and bad for the incumbent firms. The incumbent firms admit that. 90% of people who, everyone is sort of for that. Regulation is really good. You just have to, get it right.
Right. And I think importantly, one of the reasons we're not regulated today, like we're providing reporting software so advisors can show their clients what they own in their portfolio today and what they've owned in the past. So Addepar isn't providing advice. We're empowering advisors with tech and data so they can serve their clients. Now, in the future, if we're providing advisors with more insights or maybe recommendations or listing products, then of course we should be regulated. But as of today, we don't do that, so that's why we're not regulated.
Noah, so obviously one of your constituents is millennials, and everyone, the common narrative is they're distrustful of traditional financial institutions. But are you concerned that as they accumulate more wealth, they'll leave you and go to Morgan Stanley? That's all.
That's all. No. Well, am I concerned about it? I think about it a lot, obviously.
Yeah.
But our plan is to grow with them. I mean, our customers on average, our customers who are super engaged on average are investing about $750 a year. So it's a long time before they accumulate huge amounts of wealth, right? And move to someone who's dealing with $1 million asset class. So our plan is to grow with them and help nurture them and help continue to nudge them to invest small amounts regularly over time.
And John, you must only have like young, broke, poor millennials at Betterment. No older person with money would go to your company, would they?
So people always are surprised to learn that over a third of our assets come from people who are 50 plus. So there are actually a lot of older customers using services like these. And most, I think the number one segment for us is 40-year-olds. That's where we have that seems to be like a sweet spot for us. People who have like enough money where it's it's meaningful to them, and they're forward thinking and sort of like tech savvy enough in general that they're like comfortable using services like this. It's not specific to that age group, right? Like we have 90-year-olds, we have 20-year-olds.
But maybe that seems like they're having like a financial midlife crisis. Right? Like get a Harley, go to Betterment.
It's a life event, right?
Right.
It's like, I got to start thinking about my kids' college, retirement is going to happen to me someday. Maybe they're starting to look forward to it, right? It starts to become real, and so it's those kind of times when we find people are looking for something better to do with their money.
Eric, we talked a little bit on the phone about your use of technology and big data, and I'm sure you get asked this question, but I'm going to ask it to you here in front of all these people. How do you balance off collecting data and security and privacy?
Yeah, so we're entrusted with our clients' most sensitive information. So, since the very beginning, we've had to invest super heavily in security. Prior to Addepar, we built out Palantir, so we were also very familiar with, working in some very secret, very private settings, and being incredibly responsible and careful in the way that we treated that data. So one thing that's unique about Addepar is 100% of our clients use the exact same product and platform, and the platform is fully hosted. And so we've been really on the bleeding edge of security in what the latest and greatest, having fully encrypted everything, having auto key rotations, going through the ringer at places like Morgan Stanley so that they're comfortable using our software. And so if we ever violated the trust of our clients, our business dies that day. In my monthly all hands with the entire company, I remind every single person at the company of that. And so we've gone to great lengths with the tech, the operations, the infrastructure, having the best practices with respect to security laid out. But at the same time, any sort of threat vectors that have to do with social engineering, impersonating clients, things like that, like those are the things that I think we're incredibly ruthless about, and just making sure that our clients, the trust that they're putting in us, with their data, we're living up to that and then some.
Right. Noah, can you talk a little bit about your Found Money program? I kind of like that.
Yeah. Yeah, so a corp
Who doesn't? I mean, it's,
finding money
you
it's a great thing.
come up with a better name for a program.
Yeah. So when you sign up for Acorns, you link your bank and then you link cards, so debit cards and credit cards. And as I was saying, we round up the purchases to the nearest dollar and invest the spare change. And so we're always thinking about how to help our customers accumulate more money, small amounts from other places. And so there's lots of currency, there's lots of currencies out there that exist. And so one of the concepts we had was, can we partner directly with retail companies and turn rewards into investable cash, basically, right? So we partner with Nike, we partner with Hotel Tonight, Dollar Shave Club, Casper, lots of brands that are interesting to our customers and also bigger brands. And when our customers shop with those retail companies using the card they have linked to Acorns, those companies invest into their Acorns account as a reward for shopping. So for instance, if you buy a $100 pair of sneakers at Nike, Nike invests $5 into your Acorns account. If you buy a hotel room with Hotel Tonight puts $10 into your Acorns account. Right. So we have about 10% of our customers using it now, which is awesome. And they're all kind of, I would say within a year, you can easily do 50 to 100 extra dollars, which when you're talking about $750 is a sizable amount.
Right.
So it's one of the other kind of key things about Acorns, I think you asked earlier, what makes it really sticky is we connect spending to investing, and that's a really core part of the product. And so this is another way to kind of reinforce that relationship. One step further, I'm sorry to take.
Oh, that's good. Keep going.
One step further, and we haven't gotten into this, but we're kind of interested in it. Is so you shop at Nike. Nike invests into your Acorns account as a reward for shopping through roundups and Found Money, and then you're actually probably an owner of Nike. So there's something interesting also in that virtuous circle of shopping, them investing in you, and then actually owning shares in the company. And we haven't gotten into that yet, but we think there's something psychologically fascinating about that kind of interplay.
You're looking at him like we haven't gotten into that yet. Is he going to get into that? Is that what you're thinking?
So not that exactly. I like that idea, but we think the world is headed toward this far more personalized asset management place. And I think probably anyone who's in my business probably has a similar vision and product roadmap for wanting to take everything that we know about you and use that to help you maximize your money, right? Like that's what we should do. It's what financial services should do. It's not what they have done in the past. Yep. They've sold you a bunch of products that, I sell the same product to you and to you.
They had inventory.
They had
inventory.
Right.
That's how it works.
So we look forward to a world post-mutual funds, post-ETFs, where I can create a portfolio that's perfect for you because it takes into account your goals, your preferences, your values, any sort of beliefs or hypotheses that you have, with our advice and guidance about what makes sense for you and feedback on that, and machine learning and all these kinds of things that we can do to better guide and advise you. And then that is actually the best thing you can do with your money. You can't get any better than that, like perfectly personalized portfolio.
But wait, let me push back on that. I mean, how would personalization, I understand, like I'm in the content business, personalization's great. I want to know about the, Washington Wizards or something, right? Great. But how does personalization work? I mean, I grew up in this town, so I should buy that stock. I mean, maybe that's the wrong thing. I mean, how would that actually work?
So where you grew up probably doesn't matter unless you're still living there today.
Or if I worked in a certain
there,
industry. I mean, just give me an example.
If you live in New York, you want to have maybe New York community bonds in your portfolio. If you live in California, you want California. That's a simple example.
Yep.
If you're in a high tax bracket, you do things a little differently. If you have more money in IRAs or in a Roth versus a traditional IRA, you do things a little bit differently. Your portfolio should be personalized. If you don't like tobacco companies, they shouldn't be in your portfolio. If you believe that Asia is on a tear and it's going to continue and you want to dial that up a little bit, your portfolio should reflect that. So your values, your beliefs, your preferences, all those kind of things are you. And most importantly, frankly, the most important thing is your life, right? The life events that are happening. Yeah. So that's kind of the core of our guidance is based around what you should be doing based on how much you're earning, your assets, your spouse's assets, that full life picture that we gather.
So I want to ask you about some pricing issues that you had. Is it too strong to call it an issue?
I don't know what the question is.
Well, you changed pricing and there was criticism of it on social media. So how did you respond to that as a CEO?
There was, I think, as much So we changed our pricing in February, just for context, and we flattened it to 25 bips. We originally had a sort of 15, 35, 15, 25, 35 tiers. And we actually cut our price on far more customers than we increased price on because we flattened it. We had a $3 monthly minimum fee for very small balance accounts that we eliminated. And so most people actually saw a price cut. I was one of the ones paying 15 bips who raised to 25 bips. And my own take was, it's still a really tiny amount to pay for asset management. This is the best thing you can do with your money. I think there's always going to be people who kind of are resistant to change like that. But we know that we're building the best value for our customers. We've continued to invest in the platform. We're continuing to launch the best products in the industry. And frankly, for those customers who are going to be with us for 40 or 50 years, this is obviously the right thing to do.
Right. Well, changing pricing, obviously, you're not going to make everyone happy, and there's always going to be blowback. And that's what social media is for, probably, right? To make that case. Hey, Eric, I want to ask you about, you're this technology platform, and you're going after a lot of your clients' clients are high net worth individuals. But aren't those people sort of some of the people who are most resistant to using technology? And if that's the case, how do you get over something like that?
Yeah, so it's true that we're serving the advisors who their end clients have hired, right? So the end clients, sometimes for the end clients who are more excited to dive into the details about their portfolio, they'll use the software directly. That's more maybe typical in Silicon Valley where our headquarters are. But the end clients, in terms of trusting the solution with their data and loading their data in, we handled that in the way that I answered before. Some of the things that we're enabling those end clients to now contemplate or consider, which they couldn't before, and this I think fits squarely into Jon's vision of the future as well. Many of these wealthy individuals or families or even endowments or foundations, they have the ability to make much longer term investments with a much clearer picture of the future, right? And so we're empowering and enabling that in a way that they really hadn't been able to do that before. So one example of that is Justin Rockefeller is one of the guys on our team who runs our family office group, and he also, separate from Addepar, runs a group called The Impact. And what The Impact is doing is making it easy for family offices to make impact investments, where you're not just measuring the performance of the investment, and I had $100 today and I have $102 tomorrow, but you're measuring actually the purpose of that investment in the first place. So if that investment is trying to improve literacy rates or improve or reduce carbon emissions or what have you, the efficacy of that impact investment is something that you can, again, capture data about it and then have that data be shared by other people who are considering that same type of investment. So in our picture for the future, there are of course, all sorts of different types of people participating in financial markets. And for the portion of those people or institutions who have a larger asset base, they're the ones who are going to be able to fund things that are more ambitious, more pioneering, longer term. And if we're able to codify the results of that into data that can be shared more broadly, that's how we ensure that really the best idea wins broadly. We've adopted this capitalist ideology, I think, as a society, and we're saying that's all well and good, but it hasn't had an adequate technology platform to date, and really that's what we're building.
All right, great. So Noah, I don't know whether you studied economics in school, maybe a little bit?
Psych and economics.
Yeah, all right. Because I understand you use behavioral economics at your company. What?
So Shlomo Benartzi, who created Save for Tomorrow, is on our board, and we do a lot of work with him and Richard Thaler, and a lot of professors of economics or heads of economics departments at different colleges. We kind of think of Acorns as a laboratory, if you will. So we built a whole team around experiments, and Acorns is now organized according to what we call squads, and it's groups focused on core pieces of the business. So one is on core product, one's on the next product, one's on infrastructure, that kind of thing. And we have a team dedicated to experiments, and they're running experiments on basically every screen in the product. So we'll identify some metric we want to hit or increase, and they'll kind of go in like a SWAT team and focus on that and just tweak every single element. And so the behavioral economists we work with, who obviously understand behavior as well, if not better than anybody, will come in with all kinds of insights and ideas for us to start testing. And this is a small one, but as an example, we have a recurring investment feature that you can turn on after you turn on roundups. And you can, by the day, week, or month, you can set up whatever amount you want. So we tested, what would it look like if we suggested $5 a day versus $35 a week versus $150 a month, which is the same amount, obviously. And 40% of people adopted $5 a day, 10% of people adopted $150 a month. So we're really operating that way like a laboratory. And the results from these experiments and having a real team dedicated to experiments has been just astronomical. So we've taken, as an example, recurring, which a little over a year ago, was 20% of our customers were using that feature. Now 55% of our customers are using it. And it's just from small tweaks and adjustments.
So, by the way, how many people work at Acorns, and how are you getting the word out to consumers about the company right now?
120.
Uh-huh.
So we're relatively small. I mean, most of the growth is organic. So word of mouth, referrals. We've looked at how people share Acorns, and actually this is one of the interesting things about mobile product in particular. A lot of times it's the sharing of a screen. So it's really important to have those key screens that stand out,
Right.
one or two of them. So it's largely word of mouth, the referrals, and then we do some digital acquisition stuff and kind of the classic channels. But we've cracked Snapchat and Pinterest too, which is pretty cool.
And how old's the company again?
We've been live since the end of 2014.
Right. So you're sort of a mobile first. I mean, it sounds like you are, right?
We have a web app,
Right.
but we're 97% mobile.
Right. And what about you, John? I mean, what's the ratio of desktop to mobile at this point?
So we see more signups on desktop. Typically, when people are thinking about really investing, they're sitting down and this is a serious decision that they're making. But far more of our logins, something like 60 to 70% of our logins are mobile.
And so, what about partnering? I want to ask all of you about that in the little bit of time we got left. So, you must have a million opportunities or thoughts. How do we decide whether or not to do that?
Yeah, we've taken this approach from really day one that to reinvent this business, we have to start from the bottom up and build the custody and record keeping and all the core systems to deliver the efficiency that we want, to be able to drive down the cost of providing services to the levels that our customers demand. So we've done a lot ourselves internally. Now we're partnering with advisors on the one hand, so we have a Betterment for Advisors platform, and we work with thousands of investment advisors who use Betterment as their core platform for managing their clients' assets. And we also partner with businesses where we become their 401k, and all of the employees get the benefits of a Betterment account at work. So we're increasingly investing in partnerships like these because it's a great way to reach more people.
Right. Noah, partnerships, working with other companies?
So PayPal's our largest investor.
So you have a strategic investor then?
We do. We're going to be rolling out something interesting with them in a couple months. We have a lot of these.
I heard that.
Yep.
Okay.
We have a lot of brand retail partners. So the different found money partners we have, and there's a lot of cross promotion stuff that happens there. I mean, that's really those are our big kind of partnerships.
What about you?
Super Pro partnership. We built the platform in an open way. We opened our APIs last year. And the big reason why we see ourselves as, again, the shared platform for the industry. And so we're not going to build all the technology for everyone in finance. There are great other solutions out there for planning, for billing, for rebalancing, for trading, for CRM, et cetera, as well as additional new products coming in that are relevant to a portion of our client base.
Right.
So philosophically, we just want to partner with everyone who has a good offering that's going to add value to our clients.
So last question, Betterment buyer or buyee?
Buyee. We are investing more and more time looking at the market, looking at M&A opportunities to see what's out there, because I think there's a lot of ways to extend our platform, and as you say, there's interesting things that people have built, and so we're looking around.
All right, great conversation. Wish we had more time, but we're out of it. Jon Stein, Noah Kerner, Eric Poirier, thank you so much.
Thank you. Thank you.